when I looked at it, I went, wow, this, because I've been saying for quite a number of years that silver is destined for triple digits. You just can't print this amount of currency and have a commodity that is measured in that currency, which is, throughout history, also money. Hi, this is Mike Maloney, and I'm back with Alan Hibbard. Alan, how are you doing?
I am fantastic, Mike. Thanks. How are you?
Great. We've got so much happening in the world, and I just wanted to comment, the Ukraine, the Middle East, where at this point in history where there are so many dangers, and it seems like we're sleepwalking into these things. So we're going to have to make a video on this sometime in the future about the apathy of sleepwalking into what could be. We are very close to World War III, and people just don't seem to care. It's just something we've got to make a future video on it. But for now, we've got another video on precious metals, don't we?
Absolutely, we do. I thought for today we could go through what's happening in the markets, just give a little market update, talk a little bit about gold, silver, and a little bit about the banking sector.
Excellent. So, okay. So this is from Tavi Costa.
Yes, absolutely. He's got a nice chart that he put out today, the gold to US treasuries ratio. And he says, one must take note of today's strength in precious metals as treasuries sell off significantly. So in other words, treasuries down, gold up. A popular argument against the idea of investing in hard assets is in a rising interest rate environment, it might not be appealing to hold an asset that doesn't generate any yield. So we hear this all the time. If interest rates are going up, it's a bad idea to own gold. However, that thesis doesn't necessarily hold water when we look back in history. Hard assets delivered some of their strongest performances during the 1970s, despite the backdrop of increasing interest rates. And he's got a chart to prove it. We see the gold cycle of the 1970s that you and I have talked about many times. And of course, the bear market of about 20 years. And then these current gold cycles that sometimes we lump together as one, but it is absolutely poised for a breakout, Mike.
Yes. And, what is amazing here, the moves in gold are so much bigger than the moves in treasuries. It's really the gold price that is moving this chart all around. The way that it's tilted, what's interesting is when you look at where the mean is, it looks like, during the 70s, inflation came in two big waves. And those waves are reflected in the gold price. So when inflation is going up and the interest rates, the treasuries are going up, gold went up. So that supports exactly what he's talking about. It looks like, as far as the balance between treasuries and gold, we are still about as undervalued. I mean, it was super undervalued back in the year 2000. But, if you look at the ratio back in the 70s, it looks like we're still below the mean of the 70s and the 80s.
Absolutely. And you can see looking at the y-axis of this chart here, one represents basically the return on gold and the return on treasuries being the same. And so we're just about to break through that, where gold will be a better investment than treasuries, and it's going to happen any day now.
Wow. Okay. So what's next?
All right. What's next is actually another one from Tavi Costa. He's got the history of gold cycles. And again, he breaks it into 3 cycles. He says gold is approaching $2,000 an ounce again, now poised for a historical breakout that could mark the beginning of another long-term cycle. And then he's got a quote from Ray Dalio. If you don't own gold, you know neither history nor economics. Couldn't agree more.
I have a document where I just keep on pasting quotes in it. And I've had this document now since like 2003 or something. I've been just collecting people's quotes. And they'll make it into a book or into a video, and then I delete the quote after I've used it. But this is an excellent one that I'm definitely going to be putting in the document because it's true. If you don't own gold, you know neither history nor economics. And, what's interesting here, his arrows are not symmetry moves. A symmetry move, you would take an arrow and go right from the bottom to the top of a move. Again, Tavi here is using monthly data, because if you look at the peak of the 1980 gold bull market, you'll see that the 1980 peak is equivalent or even lower than the dead cat bounce. So that first little peak is actually $873 an ounce, and the second peak that follows it is about $600 an ounce. But when you do it monthly, they end up being equal. So we're probably looking at monthly data here, possibly even quarterly, but most likely monthly. And then if you took the symmetry move from the 2000, that arrow would be a lot longer, and you paste it to the top, except you'd probably start the next symmetry move in the bottom of that cup and handle or pan and handle that we're talking about. Yeah, that's where it would start. But either way, look at where he's got his question mark. Right about the price where our last analysis of the bull market repeating, that ended up with an $11,000 something price, right?
Yep, I think it was 11,250, but it's a round number.
Right. And so I think he's got the target correct. And I don't think it's going to be long. All these geopolitical tensions, something will lead to a breakout. And once it's back in the news, setting record highs, that's what happened from the year, in the bull market from 2000, from 1999 actually, but the news cycle started when it left that base of 206, I think it was, in 2001, and started going up. And then especially after the global financial crisis, where it put in 2008, it put in a little inverse head and shoulders pattern that more than played out. The 2008, that dip 2/3 the way up on that cycle, that dip right there is an inverse head and shoulders that really it actually made more than double the projected move. So yeah,
fantastic.
Anyway, yeah,
awesome. Well, I encourage everybody to check that out for themselves. That's something Tavi posted this morning on Twitter, or on X, excuse me.
Yeah, on X. And let me see, it's crestcatcapital.net, I believe, but Crestcat Capital is Tavi's company.
Beautiful. Well, next up here, we have another tweet. Silver is sitting right below the huge blue breakout line. It now has a red circled huge bullish reversal at big support. So we can see that over here on the right side. Looking very good. A generational, all caps, generational breakout should be incoming. So what do you think about this, Mike?
Well, I think that that is very interesting. I can't remember what type of candle they call that. Is it like a bullish hammer or something? What I can't remember.
I can't remember either.
The thing is, he does have a symmetry move. He started this from the bottom in 2001 up to the peak in 2011, and then he's pasted that same length arrow. You copy paste it at the same angle and everything. A symmetry move from the COVID bottom up to today. Now this is a logarithmic chart, and if you if you look at where that's pointing, and you take the distance of 12.5 to 25 and 25 to 50 and then 50 to 100 and then 100 to 200, this is projecting like a silver up above, well above 150, maybe 200, 250 is what it's projecting. So that is, when I looked at it, I went, wow, this, because I've been saying for quite a number of years that silver is destined for triple digits. You just can't print this amount of currency and have a commodity that is measured in that currency, which is, throughout history, also money. You can't have that be static while the currency supply is expanding. It ends up having to make up for it sometime or another. And what we've seen is, silver has been stagnant and falling lately, but to me, that just stores energy. And something, when I first started studying all of this, there was a guy, Jim Paplava of financialsense.com, and he said that the hardest thing, when you identify a new bull market, so this is back in like 2003, he had a series, a blog series that he had typed that was on his website that was very, very good and ended up being quite accurate. I think it was Financial Storm or something, Storm series. And in there, he said when you identify a new bull market, the hardest thing is to not let the bull buck you off its back. And that's when I made the decision to ride through all of the different waves. And I knew there would be a cyclical bear within a secular bull market, that there would be something that would make a lot of people give up. And that's what that cup and handle has been. It's been something, especially in silver, because it's because the high of $48 back in 2011, not getting back there. But once we break this trend line resistance that's pointed out here, that blue line that goes across the top of this, whichever ways, I'm trying to flip the chart backwards when I do this stuff. Once it breaks that, we should see $30 we should see the old highs of $25 or whatever that number one is. And then once it breaks that, $48 is going to come very, very quickly. And it's possible that during a crisis, cryptos could do very, very well, but it's an unknown. This has a 5,000-year history guarantee on it. It's a very well-known, and so I see just tremendous opportunity here. One of the problems is people tend to chase price. They buy once something is going up instead of buying when it's low. So I wish I had extra cash right now. I don't.
Yeah. I hear you, Mike. I think everyone wishes they had extra cash. a lot of good opportunities to be buying right now. So okay. Awesome. Well, let's move right along. I wanted to switch gears a little bit and talk about the banking sector.
Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video.
Gold Telegraph put out yesterday evening, breaking news: Bank of America has reported unrealized losses of over $130 billion on securities in the third quarter. $130 billion. This is not a drill. What do you think?
Well, what I like about that is they ended it with, "This is not a drill," because when I was a kid, they used to do, there were air raid drills every week or every month. There were air raid sirens in every neighborhood, and they would go out and in school, you'd get under your desk, pretending that it was called duck and cover, nuclear attack. And, when you see movies and stuff, when they say this is not a drill, that's when it's real. That's when the bombs are falling. And I've said quite often that we've only seen the first leg of this financial crisis with Silicon Valley and First Republic and the other banks the shotgun wedding of Credit Suisse with UBS. That was actually a bank. If that bank had failed, that was systemic. That would have spread across the world. But it really, according to their balance sheet, it was a bank failure. And so this is just another warning that people have that they need to get ready. Now, so do you have any other comments on this?
Well, yeah, just one other tweet that's on the same theme. It's just commenting on Bank of America in the first half of this year, not just Q3. Peter Schiff says for the first half of the year, Bank of America reported pre-tax income of 48 billion, yet ignored an additional $95 billion loss on its held to maturity securities. So the bank actually lost $47 billion. It's in worse shape now than it was when it was bailed out in 2008. So the banks are not learning their lessons. They're not learning their lessons. They're still repeating the same problems over and over. I mean, are we going to keep bailing them out? I certainly hope not.
I don't know, but it's a shame that they get to keep the profits in the good times, and then in the bad times, the taxpayers take the losses, because that's what a bailout is. It's all of us paying for the losses that they have incurred through the moral hazard, is what I can't remember if that was Alan Greenspan that introduced that term, but the moral hazard is created when the government keeps on providing this safety net, allowing the banks to take on more and more and more risk, because they don't have the downside risk. The taxpayer does. They only get the upside profits, and they don't have to pay the taxpayer back. It's just, yeah. What's your take?
Yeah, I mean, it's exactly like you said. It's privatized gains and socialized losses. So
Yes.
it's heads they win, tails we lose.
Yep.
It's crazy. I wish I had a banking license.
Yeah.
No
But the
problem.
problem is you've got to become one of the too big to fail banks. Otherwise, you're out there by yourself, sinking or swimming.
Yeah, that's true. That's true. So maybe I'm happy with that one.
Okay.
So, anyways, there's one more chart here just to put things in perspective, because it's really nice to have a visual. So we can talk about these numbers like 131 billion, but like, what do these things actually look like? Well, it looks like this. These are the unrealized gains and losses on securities at commercial banks, all of them in general, not just Bank of America, in billions of dollars. And you can see this goes back to the 2008 financial crisis. It's a lot worse now. It's a lot worse now than it was back then.
So point out the losses in the 2008 financial crisis. But yeah, right there. So that was the global financial crisis. And then you look at what's happening today. It's just unbelievable. Yes, this in March, when Silicon Valley failed, that was just the very beginning of the banking crisis. And what was hilarious is the CEO, I believe it was, either CEO or the head of the board of directors or whatever of Silicon Valley Bank, was also on the board of directors of the San Francisco Federal Reserve, or he was the president of the San Francisco Federal Reserve. So he should have seen this coming. The people that run the monetary system, I'm just convinced. I mean, I look at the things that Janet Yellen says sometimes, and I'm going, are these people like just total idiots? And I really think that there are these super brilliant idiots that they're so smart, they get convinced that they can't make a mistake, and they look at one set of data, but they fail to see the big picture very often. And because they don't think they can make a mistake, it leads to catastrophic outcomes.
Yeah, there's a quote that comes to mind about I think of it whenever I think of these very, very important central bankers and certain politicians who only seem to move in one direction. The quote is something like, a man will never understand something if his income depends on him not understanding it.
Yes. Excellent. True.
Yeah.
Okay.
Yeah.
So
anyways, I know we talked about like some scary things here, possibly bank failures and a global crisis and so forth. I want to end on kind of a humorous note with a chart of the day. If that's okay with you?
Sure.
All right. This one I found on Twitter. It's average female height per country. You can see this beautiful graphic here. India, very small over here at 5 feet, 0 inches. And Saba Ibrahim says, as an Indian woman, I can confirm that too much of my time is spent hiding behind a rock, praying the terrifying gang of international giant ladies and their Latvian general don't find me.
That is absolutely hilarious. Notice that the graph starts at 5 feet and goes to 5'5".
Exactly.
So it's 10% of the total height. and, and but this shows how graphs can lie. We worked a long time on chapter 3 of the Great Gold and Silver Rush, and it was just so that people can see this kind of stuff. You got to look at those scales. You got to look at how can they lie to us. Show that graph one more time. Look at how small it makes that Indian woman look and how giant it makes the Latvian woman look. And it's a 10% difference. It's 5 inches in height on top of a 5-foot tall woman. That's the difference. And so I see this all the time being used in, like, a lot of financial columnists, writers. They'll say such and such a stock cratered today on the news that, and they start the graph at 99 and it goes to 100. It looks like it's just falling off of a cliff, but actually, if you started at 0, you cannot see the move. It didn't crater. It made like a normal one-day move. And so it's just a way of sensationalizing things and exaggerating everything to try and sell you something or keep you scared or manipulate you. And so don't let them. Everybody that's watching, learn as much as you can about reading graphs. It's important. It'll serve you for the rest of your life.
That's right. That's right. Yes. And so one of the comments on this tweet was the importance of a good y-axis. So I couldn't agree more. It's very, very important. Yeah. You got to know what you're creating, and you got to know what you're reading.
Okay. And with that, I think we're going to wrap up this video. So I want to thank you a lot, Alan, and thank everybody out there for watching. Thanks, Alan.
Thanks, Mike.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.